It is time for today's three-stock lunch. Three movers in focus for today's menu. Shares of Johnson & Johnson up. The company reported adjusting earnings and revenue that beat expectations and raised its full-year guidance, citing strength in units, including pharmaceuticals. Catalent in the news lately, the stock following after reports that Danaher is no longer considering a takeover of the contract manufacturing. And Lockheed Martin hits record highs after reporting Q1 earnings beat and reaffirms its 2023 outlook. Let's bring in David Wagner, portfolio manager with Aptus Capital Advisors. First up, Johnson & Johnson.
So, Robert, I think the big question for most investors today is, why the heck is this stock down 3%? I mean, you had the company beat on all three segments. Not only that, you actually had the company raise guidance on both the top and bottom line. I think the cynical side of me would say, yeah, the company beat on the pharma side due to the COVID vaccine, and no one really cares about that. And then you have the Stelara drug, potentially eroding a substantial amount of revenue by year end. But all of these factors are known, Robert. You've actually had more recent information here be very, very positive. Just last week, you had the talcum powder become less of an issue. And I think that the company, finally feels that they have, as much visibility as they can, seeing it, that there's a light at the end of the tunnel. But, I understand that Johnson & Johnson's growth isn't as great as what it has been historically. But, it hasn't either been the multiple. It's trading well below its historical averages and well behind its peers. So I think that the market really, underappreciates the strength and the durability of their segments. And if you get any upgrade or turnaround in the device side, I think you could actually see the stock trade at a multiple closer to 16 times 2023 EV to EBITDA, where it's currently trading at 13 times now. So really just any improvement in sentiment, you could really get closer to $200 with this stock without, really anything heroic happening.
The enthusiasm for J&J, Dave, I love it. All right, what about Catalent?
Well, it's not there at all, actually. I understand it's a good company. It has good assets, and there's probably going to be a lot of pharma outsourcing, over the next 10 years. But that's not the question. The question here is, do they have the leadership to do it? They just recently canned their CFO, and it appears that there's not a whole lot of confidence right now in their newly appointed CEO. Then just last week, you really had some news come out that they're having some problems on their production side at some very important facilities. But, this is only 3 of their 53 facilities that are having problems. So investors really just don't know why you fired your CFO here. Is this an operational issue with just a few facilities, or there's really other more structural execution issues outstanding? So basically, I think that investors are really trying to figure out, using the mosaic theory, is there anything else here? They're wondering if there's other quality control issues within their site network. So basically, it is a fear of the unknown for Catalent. And when you're investing in the unknown, that's nothing I want to take part of. So I'm definitely staying away here.
Yeah, as are investors. Then, David, final name, Lockheed Martin, which had a good earnings beat.
Yeah, Robert, I'll be frank with you. And I actually thought this was a very good report out of Lockheed today. But if you had to poke holes in this report, I'd say that their book-to-build ratios on the aeronautical side was a bit weak. But, that's not a really big concern for me. We know how the F-35 works, and this has probably been well flagged, actually, by the company. But, as of right now, it feels like, owning Lockheed, it's going to be more of a macro play than a fundamental play, given their well-balanced valuation. It's basically a call on the sector for defense. If you're a bull, you're basically saying that geopolitical tensions, well, they're going to remain elevated. If you're a bear, you're obviously saying the exact opposite. But 2, you're probably saying that, there's going to be muted growth for the rest of 2023. Ultimately, I get more nervous in this stock when the rubber meets the road, regarding the debt ceiling. Any comments on defense spending is definitely going to have a lot of sensitivity towards the share price. But as you just mentioned, earlier, technically speaking, the stock finally traded above $500, which has been about a 1-year resistance level for the stock. So I'd say look out for now, but it should probably be a good hiding spot moving forward, especially in industrials, because I think there's a lot of other industrial names out there that probably worry me a bit more. So if I held it, I'd continue holding.
Yeah, it'd be interesting to watch all these defense stocks around the debt ceiling in June or July. Dave Wagner, thank you very much, and thank you for being frank with us.